If you've paid attention to the economics news lately, you've likely heard one of two stories dominate. It's either price inflation this and runaway inflation that, or it's the Fed's raising interest rates again and mortgage rates are hitting record highs. And that pervasive news cycle can be exhausting. Yes, they are very important topics that affect a lot of the way Americans feel, but what a lot of people don't seem to realize is that they are inverse positions of the problems we face. We can't solve both at the same time, at least not because of the situation we find ourselves in. And I know that sounds terrible to hear, but today I'm going to talk about why that is and hopefully give some context around the situation. To start our discussion, it serves us well to briefly recap the economic situation we find ourselves in the year 2023. And that starts with the COVID pandemic. Sound like a broken record, but it's where it all begins. The COVID pandemic of 2020 and 2021 drove lots of people to stay home to fight the spread of the virus. As a result of a lot of people staying home, they built up large amounts of savings that they would have otherwise spent on things like gas, airline tickets, hotels, eating out at restaurants, entertainment, and other services. As people stayed home, they decided to buy physical goods that they could enjoy at home. Books, electronics, additional groceries, toilet paper, exercise equipment, home goods, building materials, etc. So you had this big buildup of demand for these physical products. On top of that, in the United States, you had a massive extension of benefits to the American consumer, including things like the 3 stimulus checks that were sent to all American families that qualified, the extended and boosted unemployment benefits when people lost their jobs due to the pandemic, improved food stamp benefits, eviction moratoriums, meaning that renters could go arrears in paying their rent if they wanted to, student loan moratoriums, meaning that student loan borrowers didn't have to pay off their debt for 3 years. These benefits increase the amount of cash and ultimately disposable income going into the American consumer's pockets. In essence, the demand for physical goods skyrocketed and the American consumer's wallet was deeper than ever before. On top of the increasing demand, many manufacturers faced significant challenges with the pandemic. There were work stoppages and logistics challenges to figure out with a virus that had no concern for geographic borders. As we see the increase in demand for the goods, that meant that manufacturers needed more input goods to make the products that these customers wanted. But the raw material producers faced the same challenges that the finished goods manufacturers faced with the pandemic. The shutdowns, the stoppages, shipping problems. The end result was a shortage of materials and products across the board. So when you have a massive increase in demand and a constrained supply picture, you guessed it, you're going to see the prices increase. The demand is there, the supply is low, so raw good producers can charge more for their materials and manufacturers charge more to cover the increasing costs of the goods. The end result is high inflation, which is what we see in 2021, 2022, and leading into 2023. If you are enjoying this video, then I demand that you supply me with a like and consider subscribing for more business and economics content in the future. Okay, so prices take off and Jerome Powell eventually gets around to seeing that inflation is a problem. It takes them a while to see it, but they get there. So how do you fight inflation? Well, inflation happens because there is a lot of money circulating in the economy. Remember all those governmental benefits and the reduced spending on services and redirected cash towards goods? Yeah, that's the money we're talking about. You get that money out of the economy by raising interest rates. How does that work? By raising interest rates, the Federal Reserve effectively increases the level of risk-free reserves in the financial system. For example, you can take your cash and invest it into U.S. bonds at a higher yield, say 4%, than you could prior to the interest rate hike. U.S. bonds are considered risk-free because the U.S. government has always paid its debts. So by investing your cash in that enticing bond, it is no longer available to you to buy, say, a flat screen TV. This limits the money supply available for purchases of riskier assets, say Pokemon cards or NFTs. And on the borrowing side, it's now more expensive to borrow. If I want to buy a house, it's going to cost me more money in that monthly mortgage payment than it did prior to the interest rate hike. So I may decide not to borrow the money, and thus that loan doesn't happen, and it doesn't introduce more money into the money supply via that borrowed credit. And of course, as business conditions tighten via rising interest rates, banks will be more scrupulous with whom they decide to borrow to, restricting the issuance of loans even more. So you can see where this dichotomy comes into play. Inflation is high, so we need to stop that. We do that by raising interest rates. When interest rates rise, well, of course, that means mortgages are going to be more expensive. And as a result of more expensive mortgages, that means that home ownership is going to be unaffordable for more Americans. And what we see in the news cycle is that both are still talked about because inflation hasn't fully subsided yet. And in fact, it's proven to be quite sticky, meaning that it has been more pervasive than we hope. But remember, interest rate hikes take a while to work. It's not like we raise it one day and then the next day everything is resolved. No, it takes time for these things to go through the business cycle and play out. And that's why you see both elevated inflation and these higher interest rates. And thus you see the news cycle complain about them. Also, I want to say that the news cycle likes to induce hysteria or outrage into their articles. It's what gets clicks or readers' attention, but looking historically at a long enough period of time, we see that these interest rates are actually normal. They don't feel normal because for the last decade, America has been on a low interest rate debt binge. The Federal Reserve has put their pedal to the metal and they've been flooring the economic engine ever since the recession of '08. But interest rates above those astronomically low numbers have been around before, and the world didn't seem to collapse then, and I don't think it will now either. So when you see the news cycle harping about both of these issues at once, yes, they are problems, but they can't really be solved at the same time. Not after the situation we find ourselves in after the massive influx of cash into the economy during the pandemic. So which do we solve first? Well, inflation is the priority. Runaway prices are bad for the economy and bad for every consumer in the economy. Jerome Powell, chair of the Federal Reserve, has pledged a fight against inflation, and everything they have done so far in the last 2 years has been to curb the rising inflation. And I believe they will stick with it until they hit their 2% inflation target, which rates are not at yet. So buckle up, because we're still in it for now. As for the higher interest rates, well, remember, that is the tool that the Federal Reserve is using to fight inflation. So they're going to remain high until inflation is tamed. And also remember that higher interest rates hurt borrowers, mainly people that need home or auto loans. This is a subset of the economic population. Everyone faces rising inflation prices, but not everyone is borrowing at a given time. So if you wanted to look at it from the greatest impact, it would be inflation is a higher impact than interest rates are to borrowers. So hopefully that helps clarify. If you see people complaining about both inflation and cost of mortgages, yes, they are problems that suck. But one, mortgage rates, is a symptom of our fight to stop the other, inflation, and that's just how it's going to be for the near future. If you like this video, consider checking out the one on the screen now. Thanks for watching, and I'll see you in the next one.